Okay, good afternoon, everyone. I'm going to assume that you're all logged in now. Sorry for the delay. There were some technical issues. No matter how long we've been on Zoom or Teams, it never fails to let us down at the most critical time. But by way of quick introduction, my name is Benjamin Quinlan. I'm the CEO and managing partner of Quinlan and Associates. We have a very special event today. So thanks for those of you who signed up. We have over 100 attendees for this session on the evolution of financial markets, digital money, and atomic settlement. And some fantastic speakers in the lineup for two sessions. The first part is 45 minutes where we'll be examining digital money more broadly. You're obviously going to be hearing a number of perspectives from people that have different vested interests or who look at this space from their unique angles within their roles in the ecosystem. After that 45 minutes, we're also going to be having a back-end session, 45 minutes on atomic settlement. So that will run from 5:45 p.m. Hong Kong time until 6:30. We do hope you can stay around for the full session. It should be very fruitful and extremely interesting. But I think without further ado, I can just quickly introduce our speakers for session one, and that's the session on digital money. So we have with us today, it's myself. I will be moderating the discussion. We have Mr. Tirupam Goel, who's a senior economist with the Bank for International Settlements. Mr. George Cho, he's the Chief FinTech Officer at the Hong Kong Monetary Authority. Mr. Boyan Obradovic, apologies if I butchered that, Boyan, Chief Digital Officer at HSBC, and Mr. Yankee Chan, VP of Strategy and Policy at Circle. So I think without further ado, we can launch straight into it, and we'll actually start the session with what should be an interesting overview discussion and presentation by Tirupam from the BIS. I believe, Tirupam, you have a presentation that will give us a little bit of color on digital money more broadly, and as well as your perspectives on this new form of digital money that you have coined called reserve-backed tokens. So we're all fascinated to hear about it. Over to you.
Thank you very much, Ben, and thanks to all the organizers for the opportunity. The title of my presentation is The Search for Digital Money, and my objective will be twofold, as Ben mentioned, to set the stage for this panel and also to introduce another form of digital money. And the views expressed here will be mine and not necessarily those of the BIS. So with that, let me jump right into, so on the next slide, please. New technologies such as tokenization are raising a fundamental question around what constitutes the ideal form of digital money. Indeed, users want the advanced features that tokenization enables, such as atomicity or programmability, which then means that if money issuers do not innovate, they will see their monies fall behind. And this is precisely why stakeholders are taking multiple initiatives, and central banks are experimenting with retail CBDCs, commercial banks are working on tokenized deposits, and tech players are working on or already issuing, many of them, fiat-backed stablecoins. So, but it is important to acknowledge that these initiatives and these money forms are part of a continuum. So on the next slide, if you consider an XY plane where on the x-axis, we have the riskiness of the money backing, and on the y-axis, the riskiness of the issuer of the money. So in this space, retail CBDCs are at the bottom left. And this is because they are issued by the central bank, which is the safest issuer, but also they are backed by the trust in the government, which is ultimately safe. By contrast, in the middle bubble on tokenized deposits, banks are inherently risky organizations, and this is why the height of this bubble is greater than that of the retail CBDC bubble. But it is also to the left, to the right of the CBDC bubble, because deposits are backed by safe assets, central bank reserves, but also risky assets such as loans. And then we have stablecoins, the new game in town. They are even higher than deposits in this XY plane. And this is because so far, stablecoin issuers are either lightly regulated, and some of them are even non-compliant in one jurisdiction or the other. But they tend to have low risk assets on their asset side, which is why the stablecoin bubble is slightly to the left of the deposit bubble in this schematic representation. Now, it's important to acknowledge that the stablecoin bubble will likely move to the southwest corner of this plane as stablecoin issuers become more well regulated. But it's important to note here overall that we have this distinction between public and private money. Now, against this backdrop, on the next slide, I would like to introduce reserve-backed tokens, which is another avatar of digital money. So RBTs are tokens that are solely and fully backed by central bank reserves. They can be issued by any eligible and well-regulated private entity, and this could be even non-banks or tech players. And they would entail a dedicated RBT reserve facility at the central bank. Now, there is precedence for an RBT-style arrangement, and very much so in Hong Kong, where currency notes are issued by commercial banks, but fully backed by certificates of indebtedness issued by the HKMA. Relatedly, Alipay wallet balances are also fully backed by central bank reserves. And there are, if we go back further in time, there are similarities with the narrow bank proposal from 1934, also known as the Chicago Plan. So where does an RBT lie in the continuum that I just shared? So on the next slide, if we, slide 4, please. Yes. So yeah, on this plane, and now if we move to slide 5, we can see the RBT bubble appearing right above the CBDC bubble. On the next slide. Thank you. And this is because the RBT is a form of private money issued by any eligible player, which makes the riskiness of the issuer greater than the riskiness of a retail CBDC issuer, the central bank, but still at par with that of the riskiness of banks, because ideally RBTs and banks would be regulated on the same risk, same regulation principle. At the same time, the riskiness of the backing of an RBT and that of CBDC are at par with each other. Now, on the next slide, the next step is to compare these different money forms in terms of their other attributes. So I will not go over the details, all the cells of this table, but let me highlight a few. One is in terms of the intended purpose. Deposits are different because they are not just a means of payment, but also a store of value, and they pay interest. And this is what makes tokenized deposits different from the other means of payments. In terms of the revenue source for the issuer, again, all of them bear some kind of transaction fee, and this could include platform fee via value-added functions. What is special about RBTs is a potential interest on the reserve balances at the central bank. And as I argue in my paper, this might be crucial to make the RBT model viable and competitive, given that stablecoin issuers earn interest on assets and deposit issuers, that is banks, earn an interest margin. That said, I envision that RBT can be designed more flexibly compared to retail CBDCs in terms of the issuer choosing the transfer model, whether it is a bearer model or a burn mint model, or the degree of compatibility with public ledgers. And at the same time, the distress probability or the violations of singleness, as the BIS work has shown, is likely closer to 0 in the case of RBTs as compared to a positive probability of deviation from par in the case of fiat-backed stablecoins. So on the final slide, let me conclude with the thought that Financial technology is changing and money must adapt. There are strong contenders in the form of retail CBDCs, fiat-backed stablecoins, and tokenized deposits. What RBTs can do is pose a unique combination of benefits, in particular, more flexible design relative to retail CBDCs, more stable in the sense of deviations from par than stablecoins, and less prone to runs compared to tokenized deposits, and less encumbered by legacy features. Let me stop there, and I very much look forward to the views of my fellow panelists. Thank you, Ben. I think you're still muted, Ben.
Thank you, Tirupam. A nice, clean, clear introduction to the different kinds of digital money and where they're evolving on the broad spectrum of how we can look at these asset classes going forward. And of course, the panelists today all are coming from different angles and perspectives with respect to the digital monies and initiatives that they are pursuing or backing in their various roles. So we're going to move on to the panelists and get some perspectives now with respect to the value add of these tokenized digital monies. So the broad question, and let's keep it open, where do you see the value add of these vis-a-vis where we are today in the context of the current financial system? So maybe we can start with Yam Key from Circle. Interested to hear the perspectives on stable coins in particular, its role in the past, how it's evolving right now.
Great. First, thank you, Ben, and thank you to the Quinlan Associates and BIS in organizing these events. I think it's a great way to kind of exchange views, and I've been doing quite a bit of different panels, and every time they get a different set of people, so it's a lot of fun. For those of you who are not familiar with Circle, we're the issuer of the largest regulated stablecoin called USDC, and for some context, USDC as of now has around $31 billion in circulation, and we've seen 12 trillion of on-chain transactions. So it's a fairly well-tested instrument on Web3 rail. I think the first thing is maybe I will not bury the lead, is that all of these different type of tokens can all exist, and they serve different purposes. And I think the important thing here is really market choice and user choice. I think a lot of past debates have sort of framed, CBDC versus stablecoins versus tokenized deposits, and frankly, it's too early to tell sort of what is going to really last in the market. And there are different pros and cons, I think, as we're going to talk through in this panel of each of the design, and their different needs from the users, both from a use case perspective, but also from a technology perspective that I think is worth going through. So that's the first thing. The second thing is I think the design of stable coins, the way that all of the major jurisdictions have defined it, including the proposal from Hong Kong, is a very specific type of stablecoin. I actually wouldn't call it a stablecoin. It's sort of a tokenized deposit, because not all stablecoins are created equal. And I think Tirupam laid out that on the graph, there are these quote unquote stablecoins that are algorithmic or based on other assets that have certain sort of either duration risks or a asset liability mismatch that has to be transformed in some way. Whereas the fiat backed stablecoins and the way that USDC is structured is it's dollar assets backing a dollar denominated stablecoin. It's holding high quality liquid assets, usually what we call three month duration or less, or reverse repos. And it's segregated from the corporate funds. There are monthly attestations with annual audits. A lot of what the MA has already laid out in its proposal, and tracks with what the Singapore MAS has laid out, what's currently in the US stablecoin bill, what's in the Japan regulatory framework. So there are actually quite a bit of convergence in terms of what a good, well-regulated quote-unquote stablecoin or tokenized cash is. Now, diving a little bit more on the USDC side, the way we are backed, right? It's one-to-one backed. and roughly 90% of our reserves are held in a BlackRock managed fund called a Circle Reserve Fund. It's an SEC registered fund. It's got a ticker on it. People can go in and see specific coupons and cust numbers tied to that particular fund, as well as any sort of reverse repo that we do. And then the remaining 10% are in bank deposits, supporting liquidity in a number of banks around the world. So I think the concept that Turupan had kind of discussed in terms of RBT token is in a way providing a stablecoin issuer the ability to access the central bank balance sheet. So instead of holding reserves in either treasury bills or bank deposits, we've actually been arguing for like ability to have money directly with the Federal Reserve, for example. So if there's a way to do that directly onto the central bank, then RBTs and stablecoins in this sort of framework that Turupan had mentioned would actually be the same thing. And another way of thinking about it is others have suggested like a wholesale CBDC, where a central bank would issue this wholesale CBDC. It may or may not pay deposits or pay interest, but that other institutions, whether it is a bank or a stablecoin issuer, a private stablecoin issuer, will be able to hold reserve assets in that and be able to wrap around that to create a privately issued stablecoin. So in many ways, it's actually not that different. I think it's a question of what type of reserve it could be used in some of these assets. The other thing that I would add would be that my initial point around the differences of choice, one big question or that is TBD in the market is the technology adoption of the different type of assets. And at the moment, there aren't many examples of CBDCs. There are very few that are really live. I think there's some pilots, and even fewer that are built on sort of permissionless blockchains that are interoperable. On the tokenized deposit, we haven't seen any of those public yet. But on the stablecoins, there have been a number of different issuers, and many of the stablecoins, including Circle's USDC, operate on permissionless Web3 rails. And for us, for USDC, we operate across 14 different blockchains. And the ability to adapt to different market needs based on the ecosystem is really important. And the ability to move sort of tokens across different blockchains are also really important. And this will be things that I think is worth considering as various different forms of money gets created. How fast are they able to meet the market demand, the ability to stay in front on top of the different technology needs, and then the ecosystem that can build around it for it to have like a two-sided market. So I'll pause there, but thank you for the question.
Wonderful, thanks, Yamki. I guess good introduction and context to the stablecoin story. Let's shift it over to George now with respect to what the MA is doing on its retail and wholesale CBDC exploration. So, George, do you want to share some color as to how you see this space evolving in the context of the broader financial system?
Sure, thank you, Ben. I think Yankee has just rightly pointed out that every forms of digital money or tokenized money has their unique features. I think it's too early to say which one is the best, or at last they can coexist. So that's something we are also exploring. So I think what I'm going to do now is to give everyone a bit more understanding on what HKMA is doing in terms of the CBDC. So we have been actively exploring the realm of CBDC since 2017 to understand their benefits and potential applications on both the wholesale and retail fronts. So in light of the well-developed and diversified retail payment landscape of Hong Kong, like many other developed cities, we accorded priority to exploring the application of CBDC at the wholesale level at the beginning. So therefore, we begin our CBDC journey with Project Lion Rock, which is a proof of concept project that studied the potential applications of CBDC in handling large value payments and DVP settlements. So after that, we collaborate with Bank of Thailand to initiate a project called Infernon Lion Rock in 2019, where we study the application of CBDCs to cross-border payments. And this further developed into the project mBridge now, when we started it in 2021. So for Project mBridge, in collaboration with other three participating central banks and also BISIH Hong Kong Center, we seek to study how CBDC and innovative solutions can be applied to specifically trying to solve the key pain points of cross-border payments. So what we have done is we have completed a 6-week pilot in the third quarter of 2022. We used real value money to conduct the pilots, and we completed some cross-border transactions successfully during that period. So we are now pleased that the project has now progressed into the minimum viable product development phase, and we aim to launch the MVP in 2024, which is this year, to pave the way for a production-ready system. So this is what on wholesale side, and then on the retail front, we also, since 2021, we see there's a need to move things forward a little bit, to take a deep dive into whether or how CBDC can play a role in supporting the market developments. So while, as we already announced last year, we have not yet made a decision on whether and when to introduce EHKD, but our work under the three-rail approach is mainly to prepare for the possible issuance of EHKD in the future. So we are progressing well. Just 2 weeks ago, no, actually it's just last Thursday, we just announced the commencement of phase 2 pilot program. We completed phase 1 last year, which we identified a couple of unique values in terms of tokenization, programmability, and atomic settlement. So this, in the new phase, we will invite more applicants to work with us, join in hand, to identify some more new use cases. And at the same time, we may also delve deeper into some select pilots from phase 1. So last but not least is our very latest project with promising progress made on our Project mBridge and also Project EHKD. We are now embarking on the next chapter with a new wholesale CBDC project, which we call Project Ensemble, which we just announced earlier this month. This project aims to render support to the development of the tokenization market in Hong Kong. And this project will seek to explore innovative financial market infrastructure that will facilitate seamless interbank settlement of tokenized money through wholesale CBDC. We will do 2 things for this project at the moment. First is we aimed to build a sandbox, which we target to launch this year. On this foundation, we will further research and test a diverse array of tokenization use case, and we hope that this initiative will bridge the existing gap between tokenized real-world assets and monies in transaction. And the second thing is we will form an architecture community, which is a collaborative platform where the key players in the digital asset ecosystem will converge. And together, we hope that we will shape the industry standard and chart a future-proof strategy to strengthen Hong Kong's readiness for embracing the tokenization era. So I've been talking a lot, so I'll stop there and over back to you, Ben. Thank you.
Thanks, George. It's really good to see the Central Bank of Hong Kong getting behind all of these initiatives and pushing the agenda forward. I know the government has a broader ambition to turn Hong Kong into a Web3 hub, and inevitably this is a critical component of making that really happen. So kudos to the MA with its efforts, and hopefully all these pilots continue to take off and show some promising results. But I think now we're going to go from the central bank to Hong Kong's biggest bank and hear from Boyan, who's the Chief Digital Officer for HSBC. And Boyan, inevitably, you're going to have some perspectives. HSBC has been very involved in this space, efforts around your tokenized deposit-based treasury initiative, together with Visa and so on. Very keen to hear about what you see as the role of HSBC and how you see this ecosystem evolving?
Sure. Thank you, Ben, and thank you for having me on this panel today. Actually, I really like the composition of this panel, giving different perspective on this, and actually, very importantly, that essentially all of these parties that are represented here are continuing to have active dialogue in this fast evolving space, and that these type of sessions take place relatively frequently because things are moving pretty fast. Now, if we just take just to kind of contextualize this from a commercial bank perspective, if we think about the money today in its electronic form, over 90% of that money today, all of us use our commercial bank liabilities, essentially that what we technically term as M1, that commercial banks manage. That's the situation today. Very few markets, especially here in Hong Kong, we're headed towards a cashless society, and many markets are headed towards that. There is a very small percentage of money today that is actually central bank liability or in form of cash, and then a portion of that money are privately issued forms of money and liabilities of those private institutions. Now, as one of the largest banks in the world and the largest in Hong Kong, and also the largest note issuing bank in Hong Kong, we view the holistic topic of digital money with strategic importance and are therefore, as the Bank of Hong Kong, very actively involved in all of the initiatives that both the HKMA have launched, but also that are happening in the wider industry. Now, in Hong Kong here in particular, obviously as our home market, we are actively engaged to help Hong Kong shape the appropriate next steps in terms of this fast evolving topic. So what you've seen or listened to so far here are different forms of digital money, tokenized deposits, which of course are commercial bank liabilities and commercial bank issued forms of digital money. You've heard central bank digital currencies, which are central bank issued. You've heard stable coins, which are private MBFI issued forms of digital money. But essentially, we're talking about some of these technicalities around how is this money structured, who's liable for it, how is this money backed, and how do we ensure that there is singularity happening, singleness of money that, you know, if you pay with one form, that's accepted in another. And these are all very important considerations, discussions that need to take place. And from our perspective, we think that the work that central banks doing, in particular the HKMA, through Project Ensemble, we think that that is a critical component to ensure interoperability and eventually singleness of money. Now, from our perspective, we need to think about digital money from a variety of perspectives. So I'm going to throw a bit of a different perspective now because we've talked a lot about structures of money, but we need to think about what is digital money used for today, who's using it, and what exists, what doesn't. If we look at that today, we can probably just conclude that stablecoins are really at scale the only ones that are existing out there today at a greater scale. Very few markets have implemented central bank digital currencies, and there are no real implementations of tokenized deposit in that sort of scaled sense. And I'm not aware of any RBTs. I believe this paper is just the initial beginning of that. So if stablecoins are the only form of digital money that is used at scale today, and we need to look at their use cases. A lot of the use cases are today to really settle cryptocurrency type transactions, and we see growing type of use cases in cross-border peer-to-peer payments, remittances, access to US dollar, which Yamki has talked about. These are all of the use cases that are enabling stablecoin growth. They may not be necessarily the use cases that banks are looking at initially or traditionally have looked at, which is why stablecoins have found their niche. In particular, if we think about the wider cryptocurrency perspective, and generally banks do not have as great of a risk appetite towards that. So that's what's driving the use of this digital money today. But obviously, what we recognize from that use are, I would say, broadly speaking, two things. Number one, an incredibly efficient way to send money across the world using the public blockchain network. and two, the concept of money programmability, which can bring a lot of innovation to the whole payments landscape. And these are the two areas of money that are being explored, in addition to how the money needs to be structured, as all of us here all are exploring different forms of money because we're greatly inspired by the potential of operating money on distributed ledgers, especially digital asset economy developing itself, as well as being able to transmit value and ownership across the world at fraction of a cost near instantly. These are all powerful capabilities that are really driving all of us to explore money. So HSBC are actively involved in all of these initiatives and discussions. Tokenized deposits we've done just at the end of last year. We had a successful test for intragroup payment transactions between us and Ant Group, which was, really proving out that efficiency perspective of being able to move money between different institutions on a blockchain, and that was very successful. We're participating in basically all of the projects that George has highlighted from the HKMA. We're also speaking to the HKMA about their stablecoin sandbox and the regulations that they are looking to there, because as you can see from that, it does not confine stablecoins to be issued only by non-bank financial institutions. Banks could potentially also participate in that, and that's another interesting angle to look at this. So what I would say, just to conclude this, is we're actively involved in all of these discussions. There are a lot of important decisions that need to be made in terms of how the money is structured to preserve singleness of money, but also safety of money, so that people have trust in that money as they do today. So these are very, very important decisions that need to be made. And central banks, commercial banks, as well as all of the players who are generally involved in operating money today, all have to be involved in important discussions. At the same time as looking at how we ensure that stability and safety of money is protected for wider use, we need to think about the innovation angle and how are we going to unlock the potential of programmability, as well as operating money at greater scale on ability to transport for that at fraction of a cost today, to enable that innovation in payments. So it is absolutely a fast evolving and dynamic market, and we once again see it of strategic importance, in particular here in Hong Kong.
Thank you, Boyan. Gosh, you're all fantastic speakers with so much richness. Just bearing in mind, of course, in order to keep the time for the next answers, if we could just limit things to 2 minutes a pop. Trust me, I know you could speak for 20 minutes each, no problem on every question. But let's drill in, because there was obviously a very key point mentioned by Boyan around what's being adopted. The only kind of digital money form with any form of more mainstream adoption at this point is stablecoins. And what we want to look at is, what are these broader, this next theme, what are these broader adoption implications? What are the challenges? A lot of people have been discussing things like regulatory harmonization, a lot of discussion in the market around interoperability solutions. Maybe George, from your perspective, because you've been piloting quite a few things at the EMA, what do you think it really takes to get adoption underway?
Yeah, thank you, Ben. Yeah, we do have, encounter some challenges during the course of the implementation. So our CBDC exploration journey provides more room for public-private sector collaboration, which can maximize our project learning and break new ground. But the complicated nature of CBDC also makes it a challenging and complex field to navigate, as it is an interdisciplinary subject that intersects with various fields. So the complexity underscores the importance of cooperation with industry participants is very important. By sharing knowledge, resources, and expertise, we can ensure that the development and implementation of CBDC are done in a way that mitigate any potential risks and benefits and could benefits all. So take the phase 1 of our EHKD pilot program as an example. So thanks to our partner in the private sector, our understanding of different design choice of EHKD system, as well as potential implementation issues, has significantly deepened. So such outcomes would not have been possible if we work alone. And the potential implementation of retail CBDC would entail far-reaching implication on a wide range of issues relating to areas such as legal, regulatory, policy, financial stability, privacy, cybersecurity, you name it,
Yeah.
with the existing payment methods. So it would take years to complete these hugely complex and challenging projects. So in the context of Project Enbridge in particular, is a cross jurisdictions project. Is a collaborative efforts of multi-central bank institutions, a well-developed and fit-for-purpose governance structure is therefore necessary to outline the roles and responsibilities of different participants and how the platform developed for Project Enbridge is managed and controlled. To a certain extent, technology is a less of a concern, frankly speaking. So the major challenge actually comes from other parts, apart from the technology. So in summary, a new technology form of currency and a multi-CBDC platform raise challenging legal questions that depends on each participating jurisdiction, standing rules and regulations, and may require regulatory changes to achieve full legal certainty and clarity. So further exploration of policy, data privacy, and governance consideration is also required to fully unlock its potential. So I pause there. Turn over to you.
Couldn't agree more. I think the themes coming out, it's kind of like coordination, collaboration, and alignment wrapped around every other consideration that you put in there, which is, it's very comprehensive. Boyan, do you have more to add to that by way of what's going to drive the adoption agenda?
I think George has covered some key risks that need to be evaluated and how we get there. In addition, I would just say a key theme is interoperability, as all of these initiatives are essentially existing right now as individual initiatives, and they're all moving forward individually as we're trying to innovate and develop new capabilities. We all foresee a place where they're going to coexist, but then how do I ensure that if I send you, Ben, one USDC, that you can actually interoperate that with one HSBC coin, whatever that ends up being, whichever. How do we make sure that maintains the same value? So that is an important consideration that needs to be made. And I would say that how we structure the future of financial markets around all of these different topics, as we develop digital assets in particular, and this is not to be undermined, one of the biggest use cases for digital is going to be settlement of digital assets and just wrapping a digital asset value and ownership into that token and being able to transmit that across the world. How do we unlock that? How do we develop a digital asset economy beyond cryptocurrencies? How do we tokenize these assets and then ensure that the entire efficiencies can be brought together? There's a lot of considerations that need to be made there. And then finally, from adoption perspective, how do we ensure that this digital form of digital money, whichever one it is, if market forces are going to determine which one is going to be most used, then it'll be about what are they used for, which use cases, and which forms of money are going to be best for which use case. For example, CBDCs could be fantastic for public fund distribution use cases, but for private where programmability comes into play to add new capabilities and features on the way that we do payments, it could be commercial organizations running that with commercial bank, for example, issued forms of digital money or others.
Very, very well said. I guess we can now shift over to Yamke's perspective. I mean, you operate in the space where we have seen some degree of adoption. What are your thoughts around, are there continued hurdles? How is this going to really go mainstream?
Well, first, I think in a way, stablecoins are already mainstream. At 31 billion in circulation for USDC, there are a couple others as well. They're in the billions, and 12 trillion on-chain transactions. I think that the question here is, how do we build a better future together? And how do we take the best of the technology, which in the case of blockchain is globally available 24/7, both a database and a compute mechanism, and layer with that the things that we have as a society, rules and regulations and trust. That's really, really important. You can't have a world where it's completely open with no level of trust, and conversely, you can't have everything 100% trusted that doesn't interoperate. So I think that on interoperability, please, I would focus on two areas. One is on technological, and the second is on regulatory. On the technological, I think Boyan kind of touched on this, but as these different systems or types of money gets created, are there ways for them to move across the different technology rails? Obviously, we have a strong preference for open permissionless blockchains, but we know that banks may not be able to operate on that, and the willingness of central banks to be able to operate on that is even less. So what is that bridge? How do you go from one USDC to one HSBC coin to one Hong Kong dollar? How does that work? And does it work at scale and atomic and immediate? Or else you're back into sort of these wall gardens that we used to have.
Yeah.
And then on the regulatory part is really even looking at Hong Kong's proposed framework. Is this framework able to allow Hong Kong to be an international financial center that allows stable coins that are well regulated in different jurisdictions to be able to move within Hong Kong, or does it only allow Hong Kong issued stablecoin to be used in Hong Kong? I think that's really important, because if that's the framework that each jurisdiction takes, then by regulation we go back to a wall garden. Then you go back into that each different jurisdiction has their own different stablecoin, even if they're the same currency.
Mm-hmm.
So I think it's really important to think about how do we build in such a way we have an ability to build a whole new industry to have scalability in a trusted, well-regulated way. And the other piece I would add is that we don't know what new markets will be created from this new sort of form of money. Every time we've gone through a major technological change, new economies get built. When broadband came about, we didn't send email faster. We created like video streaming and video chats and e-commerce at scale. We don't know yet what instant atomic payment and programmable money would look like. And we don't know that, especially in the context of the AI evolution, where machines will be able to talk with one another. I think it's really important for us to get the foundations right so that we can take advantage as a society, and especially as Hong Kong, for this new economy to come.
I completely agree. The space is moving so unbelievably fast. Even as a consultant, it's hard to keep on top of things every single day, even though it's our job. So that brings us to a couple of things. So I'm just going to share a paper that was written by Quinlan Associates with BISIH. For those of you who haven't come across it, I'm sure some of you have, on the wholesale adoption explorations of CBDCs, stablecoins, and deposit tokens that was published last year. So it's a good background primer if you want to read up about where the industry is going and some of the perspectives that are being balanced in this discussion. Now, like all good webinars, we are running behind time because there's a lot to discuss, but we're just going to touch on this last piece around future outlook, and we'll try and keep this a bit more quick fire. We'll leave time at the end, just so you know, for everyone there, for one or two quick questions. So there's a Q&A box at the top. If you have something to ask, please ask it, and then we'll try and address one or two at the end. But let's go to future outlook, and then let's round this all the way back to Tirupam. I mean, as the central banker economist, you've been listening. You obviously gave a great primer at the start. You now hear the perspectives. Where's this all going to go, in your view?
Thanks, Ben. So thanks all for those very insightful interventions. So I couldn't agree more with what Yamki and George mentioned in their initial presentation, which is about the coexistence of different monies. But just to add a little bit of color to that, I believe that to be able to look into the future, we must also first look into our past. And since a long time now, we must acknowledge that public money in the form of cash primarily and central bank reserves and private money have coexisted. And this two-tier monetary arrangement is not a coincidence, and there are good reasons for why it has survived the test of time. Because public money has served as the monetary anchor. So even though cash usage may be 10% of the overall payments, that the fact that private money can be easily converted to public money is crucial for the trust in the money overall. On the other hand, the private sector is at the forefront of serving the end user, as Boyan emphasized. and they have demonstrated their comparative advantage in innovating. So that should be acknowledged. That said, today what technology is doing is it is affecting the balance of public and private money. And the recent BIS study has found that there is increasing preference for digital payments as opposed to cash. Not surprising. So going forward, it will be important to maintain this balance of public and private money. So in that sense, my view is that on the public money side, cash needs a digital cousin, or a digital retail cousin in the form of a retail CBDC. And on the private money side, there are many contenders. And I fully agree with the view that we need to experiment. It's too early to tell. But what policymakers need to ensure is that whatever new money comes to the market is safe, while at the same time not stifling innovation and maybe going even a step forward and creating a fertile ground for innovation. And what HKMA is doing with the sandbox is a step in that direction. So to summarize, different forms of private money can very well coexist. Once safety is ensured, customers will be the judge of what works best. Thank you.
I think it's really nicely said. Coexistence, and ultimately how this space plays out is going to be determined by the end users. So yeah, I think that makes perfect sense to me. Boyan, what's your perspective? Do you have a different view, or do you align with Tirpan?
So broadly aligned. Again, what I would say is just to really kind of underscore this message, we've got some very important decisions that collectively need to be made, public-private, in terms of how the money needs to be structured, who is liable for what technology do we operate it on, private versus public, how would this work, programmability, who's going to do the programmability, how are we going to ensure that those programs are not, that they're fit for purpose, how do we bring the broader innovation perspective to light, and then how do we ensure that whatever forms are issued are all interoperable. So this is the other thing I will mention is, based on my experience so far, this topic that we're discussing here is not very well understood by the broader public. I mean, crypto, yes, but in terms of digital money, the number one question I get is, I don't understand. I thought the money that I see in my PayMe wallet, for example, is digital money. So what are you talking about? Is this new form of digital money? And that we just need to be conscious of that factor as well, in terms of how does the broader public perceive money, and what do they see as forms of digital money, including what they perceive to be today's forms of digital money. So that would be the sum of it.
Great perspective. Yamki?
I think I'll look further into the future is what I'll do. I kind of hinted at it at my last intervention, but what does the world look like when we have the ability to pay anyone on the internet at the speed of an email? What does that mean in terms of e-commerce and growth of the economy? What does that mean in terms of wealth protection and wealth investment and increases? What does it mean in terms of economic development and jobs? I think those are the things that are the ultimate goals that we're trying to get to as a society. And right now, there's a lot of friction with the way money moves, some for very legitimate reasons. But as we use technology to improve upon, KYC and other things, then we're able to remove some of that friction. How do we look at economic growth and the new industries that could be created?
Good perspectives. And finally, George.
Thank you. In the interest of time, I'll try to be quick. I think Hong Kong has always championed innovation and international collaboration. So we hope that our multi-phase-sided research on CBDCs will continue to underpin the Hong Kong broader work in exploring the roles of CBDC in the future digital money landscape. As mentioned earlier in the first discussion, that the Hong Kong MA will continue to step up the research efforts to future-proof for CBDC through our wide portfolio of initiatives, including Ambridge, HKD, and also the newly announced Project Ensemble. I think one factor is collaboration. I think is the key to success. When I say collaborations, I refer to two aspects. One is cross jurisdiction collaboration, as well as locally we put a very strong emphasis on private-public collaborations. I think this CBDC is a very big topic, and we can't do it on our own. So we will continue to engage the industry, the banks, also the academia. We will work hand in hand together to do more research and study. So I'll pause there. Thank you.
Wonderful. Thank you, George. I think the overall, sorry, Boyan.
Just one final one I was going to
Yeah.
say. Hong Kong is starting to be in a leading position globally on this topic, and it's really refreshing to see. I think it has a real chance at becoming a digital hub if it can solve for this important topic. So I think all of us in Hong Kong are energized by it.
Wonderful. I would say very much the same. There's a hell of a lot going on in this city. So for all of you involved, definitely keep it up. Now, there's two questions that came in. I'm also enjoyingly reading the chats about Q&A not being set up. I have all this covered. Don't worry. So there's two core questions that came in. One from Albasha Abbas. So I think this one, Turapam, is probably going to go to you because it refers directly to RBT. So let me read it out. Can we consider a wholesale CBDC backed stable coin in brackets project Aurum and tokenized deposits settled with wholesale CBDC as being forms of RBT?
A very good question. I think the answer to the first one is a yes. The second one is perhaps a no, because deposits are fundamentally backed by a variety of assets, whereas what I'm proposing in an RBT is fully and solely backed by central bank reserves.
Very good. Clear answer. Okay, and then we are over to one question that came in the chat. It's from Steph. So I'll read this out, and I'll let any panelist put up their hand to take this on. I'd like to know what these new types of money can contribute to providing solutions for the biggest challenges we are facing today, such as climate change, extreme inequality, political polarization, biodiversity, and more. Money is never neutral, and its design influences our behavior towards each other. Has research been devoted to looking at the behavioral aspects of these digital money systems? Really good question, very thoughtful. Would anyone like to be brave enough to give their views on the broader utility of these new kinds of digital money to facing the world's key challenges today? George,
Maybe
it looks like you're Boyan. No.
I'll chime in.
Yemke. Okay.
I think it's an extremely good question. And the way I would sort of approach it is we are seeing the use of stable coins being used for humanitarian aid situation, where we partner with UNHCR, we partner with MoneyGram and Stellar Foundation, where the UN is distributing USDC directly into mobile wallets of Ukrainian refugees. Right. This is where maybe the banking infrastructure may not be as strong or maybe a little more fragile. There's serious security risk involved. And the recipients, refugees could be in any number of countries across Europe as they move around. But this allowed them to move money among themselves with their families and then be able to off-ramp into fiat at a MoneyGram location. So I think instead of like addressing each one of the questions, it's sort of we haven't yet figured out, or I don't think we fully understood the capability of what having money in the digital wallets of people. What does that mean for financial inclusion? What does it mean in terms of being able to fund things like pay for carbon credits at an atomic level, as opposed to having to go through specific aggregators? And how do we address sort of programmable money as it relates to, for example, charity or specific purpose-bound money? So I think it's an open field. I haven't seen research done yet, but I think it's worth someone looking into the use cases.
Wonderful. Anything else to add to that?
I would try to supplement by giving an example
Sure.
for the climate change example. So I think maybe everyone is aware that early this year, the JFMI has successfully issued the second tranche of tokenized green bond. Although it is not an end-to-end, all blockchain solutions, but it has successfully proved that the green bond can be tokenized and then transact at the blockchain solution. So I think later on we will continue to do more research on this by making it a whole end-to-end solution under blockchain solution, including the payments like will also be conducted using some kinds of digital money. So what's the benefit of using this is, of course, first of all, is atomic settlement. And then with the blockchain technology and the AIoT technology, we can also include the disclosure and the climate monitoring information into the tokens. So with that, I think the investor could have a more first-hand information on the performance of the green bonds, which may further facilitate the investment of greens related projects and investment. So I think it will make a better whole benefits to the whole in terms of the green development of the world. Yeah.
Absolutely. Thank you, George. Boyan, you wanted to add one final thing?
Do you have time or?
Got to be quick. If you can, then we can do it. Yeah.
I'll just say very, very quick a few things, right? First of all, financial inclusion, that's one of the promises of CBDCs and one of the benefits, and that certainly needs to be unlocked. That's certainly what's happening in mainland China, at least with their issuances of CBDCs. So that's one area. Programmability will add capabilities to do more effective money distribution. So it could be to those that are in greater need, but equally at the same time, we need to be cautious about the privacy aspects of, restricting or diverging money, and more research needs to be done on that front. But all of what was raised here, that question is a very holistic, important question that raises many important areas that need to be explored as part of the holistic journey, which is why this is going to take time to structure properly, in addition to market forces taking their effect in terms of adoption of this money. But it's a really excellent question.
Wonderful. Look, thank you for the thoughtful question. That generated a very healthy end to the conversation. But I think just in the interest of time, we do have to move on. So I want to send a really sincere thanks to George, Yamki, Tirupam, and Boyan for sharing their expertise and their insights on this complex and fast evolving topic, which I'm sure if we have the same discussion in 6 months from now, there'll be a whole bunch of different perspectives that we just have not been able to physically and mentally unpack as of where we are today. So no, really, really sincerely appreciate it. And hopefully everyone on the call benefited from listening into these points of view. Now, I think that moves us on to the second part of the seminar today, which is on atomic settlement. So this will be led at the start by Mr. Dennis McLaughlin. So Dennis is an independent non-executive director of Canadian Derivatives Clearing Corporation and Canadian Depository for Securities. And Dennis recently published a paper related to multilateral netting benefits in deferred net settlement, which is related to the world moving towards a faster settlement cycle from T+2 to T+1 or T+0. We'll see where things end up. But I think overall, this session, Dennis will present some insights from his paper, and then we'll be joined afterwards by Benedict Nolans, the head of Hong Kong for BIS Innovation Hub, Manmohan Singh, who's the chief editor for the Journal for Financial Market Infrastructures, and George Snyder, who's the head of financial engineering for Digital Asset, to also share their perspectives on this topic once Dennis has gone through and presented his thoughts. So Dennis, thank you so much for being with us today. I'll pass it over to you and very much look forward to hearing your perspectives.
Thank you very much for the invitation to speak here. It's a fascinating conference and certainly timely given what's going on in the world. The perspective I bring here is more of a practitioner than a technologist, although for full disclosure, I'm acting right now as the interim CRO for Finality Settlement, which gives me the other end of the debate as well, and I have the perspective on both sides. If you wouldn't mind bringing up the presentation, I think that'd be helpful. Excellent. So I started to wonder about when the move from T+2 to T+1 was pushed by the SEC recently, last year or the year before, and a lot of activity went on to try and dimension the problems involved. The SEC also published something for comments, and they wanted to know, was it possible to do this even better, to even below the trade date, or even less than that, push the settlement window all the way down? And that's the way this paper came about, was to say, well, is there a theoretical, we all know there's lots and lots of practical issues with that, but is there a theoretical bound to how short the settlement time could be and still retain the benefit of net settlement? Now, the background to all this is really goes back maybe 35 years to the Bachman report, which enshrined the philosophy that less time between the transaction and its full completion reduces the risk. So that means you have less time for a counterparty to default, and you have less time for the asset to move to decline in value. That should free up capital because you need to hold less capital against the potential risks, and that capital could then be used to improve liquidity. That's the kind of underlying backdrop. So then you say, well, could we go faster and faster and faster? And more recently, this was highlighted in the COVID pandemic, where the volatility was very, very big, and people were really pushing for shorter times because they were very exposed over the mid-March events, for example. And then there were congressional hearings in the US into GameStop and Robinhood, the volatility that enshrined in that event. And so the pressure came on in the US for faster settlement times, and that was taken up by the SEC. So the next slide gives you a sense of just how much there is a global push now for T+1. So that means we go from 2 days to 1 day after the trade day to settle completely the transaction. So in the US, as I said, that is set now. We're almost there. It's May 28th, 2024. In Canada, they're following suit and keeping in sync, as you might expect, because of the connection to the DTC. India has already moved. The UK is certainly thinking very strongly about it. They have recommendations due actually the end of this year, which is a bit of a laggard because the EU has finished its comment period and is now actively debating what to do. The word on the street is it's a question of when, not if. So if you move on to the next slide, in all of these industry consultations that have gone on, there's a whole slew of reasons, especially from incumbents, why you can't do this. One is it's very, very difficult to coordinate between the various time zones involved. For example, Hong Kong and the US completely at opposite ends of the day. So you have to get all that right. So one is asleep while the other is awake and vice versa. The post-trade activities have now been halved, at least depending on the markets. So you now have half the time to do everything you used to do after the trade has been made. So that means that you have to really get the synchronization right between the various steps in the post-trade process. And you have much less time to fix any broken trades or mismatches or anything else that has occurred. Reconciliation, etc., becomes more painful. And one would expect, at least in the interim, at the meantime, before the whole process really settles down, one would expect that fails would increase fairly substantially at the beginning of this process. Probably the biggest issue is the cross-currency issue. And that comes from the CLS, which is a mammoth undertaking between the central banks, basically, to remove the Herstatt risk from foreign exchange large trades. And that operates on a T+2 settlement window, whereas equities will, from May on, operate on a T+1 settlement window. So that creates a bit of a headache, especially for traders having to immediately almost pre-fund the trade if it's in another currency. Now, this could be serious because about 20% of US securities are foreign owned. So there's going to be a lot of this going around trying to get that timing correct. And the other big elephant in the room is mutual funds in the US. While there are the underlying stocks, etc., of the mutual fund are marked to market all the time through the exchange trades that occur, the actual fund itself doesn't mark until the end of the trading completed. So T+1 is challenging for trades for mutual funds because you have to push it down to try and get there. And you're always faced with the fact that you really can't get below T+0 unless you do some tracking mechanism. And then there's a whole host of, which I won't go into, but interactions between the security markets and the various other markets. Options, the underlying repos, the bond that's being repoed, stock lending, all of these things have to be coordinated between certain markets, and that's painful to work through. Things like dividend payments, etc., have to be fully reflected, and it gets harder and harder as the settlement window shortens. Now, these are all very well known, and everybody's working on it to try and do this for T+1, never mind T+0. And it's quite a difficult task to get all these moving parts in sync to even achieve T+1. Now, we know it can be done because India has done it, but the bigger economies like the US, the equities is enormous. The equities trading is enormous. So this is a non-trivial exercise. You could move on to the next slide, please. So the SEC asked a fundamental question. Well, basically, what's the boundary? How low could we go? How much could we shorten the settlement time and still keep the what they call the deferred net settlement, which is today we have a situation where you make the trade and there are lots and lots of gross trades being made between counterparties in the markets through clearinghouses, etc. But you don't settle for 2 days. So at the end of the 2 days, you figure out what you owe to each other and you settle the net amount, not the gross amount. That's deferred net settlement. And it has a huge, I'll get to it in a second, but it has a huge benefit buried inside this. And what my paper is about, when I looked at the NSCC data, I saw that you could actually, if you leave the practical considerations aside that we looked at a second ago, and just look at the theory, you could push the settlement window down to 1 hour and still have the basics of there's no loss of the netting benefit from multilateral netting for a 1 hour window. And in fact, you could even go lower. You could get 90%, at least if you're a hub, of the potential multilateral netting in just 10 minutes. And the reason for this is on the next page. If you just move on for a second. It's just how huge that multilateral netting benefit is and just how much trading there is going on. And this is just for the US markets. You'd have to do the same for other markets to get similar results. Probably it would take longer to get the full benefit. But if you look at during 2020, I think, the CEO of the DTCC at the time, which is Michael Bodson, talked about what a normal trading day looks like for the NSCC, which is the central clearing corporation, if you like, for the US, where all equity transactions go through. And it's enormous. On a typical day, there was about 200 million transaction sides, and the daily value of the trade side destined for netting on T+2 was almost 2 trillion. That's about 2,300 trades a second were being performed on average. And these were trades done between the 155 full-service members of the NSCC. So this is an enormous machine that's going ahead in the background. And at the end of the 2 days, they were all netted down so that only about 35 billion ends up physically settling. Even though there were 1 million underlying securities movements, 35 billion settle. Of the nearly 2 trillion gross trades that were being made, we've gone down now to only 35 billion physically in cash changing hands. So the first remark you might say, well, this greatly reduces the operational risk because so few trades actually end up moving, changing hands, and that the whole process then is supported by a very, very small amount of capital that supports this gross transactions of 2 trillion over the settlement window before netting down to the very small amount. So that's a 98% benefit from multilateral netting just in the US equity markets. That's an enormous benefit that sort of provides the grease to the wheels of the trading securities market in the US. And the SEC's concern was that if you start to push this settlement window down and down and down, you could even go to atomic settlement. What happens to this? This is a huge advantage. Do you lose it, or at what point do you lose it? So if you go to the next slide, please. So there's a way to look at this a priori. And I looked at work of Duffy and Zhu, who came up with a way to see how much benefit there is from multilateral netting in a market before and after you introduce a central clearing function. And if you look at their paper, they give an actual formula for it, or they don't give it explicitly, but there is a formula. It's 1 minus 1 over the square root of n minus 1, where n minus 1, well, n is the number of counterparties that are trading. And so if you look at that, say, well, that's great. That's the end of the window. You have a formula for the benefit before and after introducing a clearing function into the market. And what you would have to do then to try and estimate this is figure out what is this benefit at earlier times before the end of the netting window. And it turns out you can actually do that. And you can do it a priori. Now, it may turn out that for individual counterparties, their actual benefit is less than or more than this. But what you have to do is design a market structure a priori that will tell you what the potential netting benefit is. And this is the formula for that market structure. Basically, it's the observation that when you go into a trade, when you start looking at trades, before an actual trade is made, and you look at any one counterparty, it's just as much likelihood there'll be a buy as a sell. It's symmetric. And they applied that around the nodes in the network, and they could calculate this formula. So I used this formula to try and calculate this benefit for times less than the end of the netting benefit, the netting window. And that's the next formula. That's the next slide, please. So how do we go back to previous generations, if you like, because this is now penetrating the trade date. This is before the end of the trade date. How do you, because you can't really observe it, or at least not easily, you need a mountain of data. But there are two principles that you kind of know would apply to whatever you can't really fully observe. One is that the participants in the market are pretty fixed, because to add a participant, add a node, for example, is quite an undertaking, because every bank has to do all sorts of credit checks and all sorts of due diligence before they accept trades with that node. And the other assumption, which is broadly accepted, is that you have trades accrue to the bigger players. People want to trade with the bigger players as opposed to the smaller players. That's the Matthew principle. So if you make those two assumptions, then you actually get a formula for what the netting benefit would look like at times less than the settlement window or times less than trade date. And it basically grows as the square root of time, which I was surprised by. So that means you can extend Duffy and Zhu's model to get a formula for the netting benefit at times before the end of the trade date and at the early stages of the network evolution. So it's the same form. It's 1 minus 1 over the square root of the connectivity of the nodes. And then you can apply that formula and see what it looks like as you let time go from 0 all the way to the end of the trade date, or all the way to t+2 or t+1. You can get a sense of what this looks like. So that's the next slide, the picture of this function. And it was, to me, it was surprising because although a priori I expected that because of the, at least in the US, because of the enormous amount of trading going on, one would reach the maximum possible netting benefit fairly quickly. I was surprised at just how quickly. So you can see the very steep climb up, because what's happening is the nodes are trading so much that they quickly amass the full netting benefit potential that they can get. And it's so big that within 90% of the benefits gotten within 10 minutes. And then it flattens out. They can't do any better after a while. After 1 hour, they've reached the maximum, approximately 1 hour. Now, this has all sorts of implications, and it can really get to the economics of real-time gross settlement if you use it correctly. So if you turn to the last slide, it's just the implications of this. By the way, this is just for the NSCC data. So the last slide, please. Yeah, so on the one hand, you have like two different views of the world for settlement. You have the deferred net settlement view that I just laid out, where trades the gross trades sort of all are squashed down, and only the net trades, net positions are traded, or cash moves for the net positions at the end of the settlement window, T+2 or soon to be T+1. That's one extreme. And about 20 years ago, 30 years ago, the regulators decided that there's systemic risk built up in that view of the world, because there's nothing really, it's very hard to stop one counterparty becoming enormous, and then all of these other counterparties are somehow exposed to the enormous credit quality of that counterparty, and there would be systemic risk if that large counterparty went. So to deal with that, to remove that, many of the central banks, and I think we're up to 90% of central banks in the world now, have moved their economies onto real-time gross settlement. And that's the opposite extreme, where settlement takes place pretty much close to instantaneously. And so you don't have this problem of the credit quality anymore, because the trade is either settled or it's not. What it does is turn that into a problem of liquidity. So the money must be there at the moment the transaction is being done to pay for the transaction. That's real-time gross settlement. And what you've got then is, in a way, you've substituted the credit quality problem in deferred net settlement for the liquidity challenge of raising the exact amount of money you need at all times during the day when you're making payments in the RTGS. So it turns out to be, that's quite a thorny thing to do. And central banks have realized that, well, that's great in principle, but you need to start adapting that wonderful solution to add what they call liquidity management add-ons or liquidity management solutions to try and make up for that liquidity challenge. Now, what I'm saying in this paper is that there's actually a middle ground. So within 10 minutes, it's very unlikely that a counterparty could ramp up so much credit risk against the rest of the system that would bring down the entire system in 10 minutes. On the other hand, it would be able to achieve 90% of the multilateral netting benefit inside those 10 minutes. And so what you've got then is a solution to the liquidity challenge of, it's not quite instantaneous settlement, but it's not very far away from it. So this was very interesting to me, because it's sort of middle ground where you can, there's something which has the best of both sides and doesn't have the extreme risks of either side of that. So that would be the solution to the conundrum that, for example, the DTCC raised, and that was raised in a paper called Steampunk Settlement, that if you're in a real-time atomic netting situation, you must have the money available right now to buy the asset, and the other side must have the asset available right now to sell the asset. So both sides must have their pieces in play in order to make the switch at exactly the instant that the switch should be made. That is quite an undertaking. And when it was tried I think in Italy in the 1500s, in exactly the same debate, although it wasn't done with the technology, it was a disaster. And the reason it was a disaster was people didn't understand the liquidity challenges of real-time gross settlement and what it means and how it needs to be supplemented by other things such as queuing, for example, or extending the window out slightly to try and borrow from the future trades that are going to come into the account. So these are all called liquidity management solutions. that try to bridge the gap between where we are today in real-time gross settlement and maybe going more towards extending a window in which some kind of netting could take place and you can get the benefit of your trades with other counterparties. The other thing that this analysis shows is in order for it to work, in order for something like atomic settlement and blockchain to work, you need high capacity, very high capacity. Just to handle the US equity markets, we're talking 5,000 trades a second. A lot of people involved, 5,000 trades a second, that's no mean feat. And of course, there would inevitably be several blockchains and several legacy systems that have to somehow interact with each other. So in order to keep that going, you have to have very fast interoperability in order to get to atomic settlement. And that's not easy either. And the final thing I would say is that you need a large network of counterparties to be able to provide the liquidity necessary, as we've seen in this example. So I think you can get to atomic settlement or close enough to it where you can keep the financing benefits that exist in today's economy and today's financial system without going to absolute cliff effects of liquidity challenges every second of the day, all the way through the day. But you need to have other things in place. So that's just, and there are many ways in which these kind of observations could go. For example, that curve will be slightly different for different markets. Obviously, the US equities market is a massive market. For other markets, it would take a little bit longer to get to the optimal time for settlement. And I haven't really addressed how you would coordinate all the legacy issues that people have brought up here about solving the mismatch between CLS and whatever you do in terms of speeding up your settlement times. So foreign currencies, bridging legal jurisdictions, etc. I have just ignored that. And I said, just from a theory point of view, how would you keep the benefit of the net settlement? So I'll just I'll leave it at that, but take questions now or whatever you want to do. Thank you.
Wonderful, and a very excellent view of this fascinating space. I think the best thing now is we can pass it over to the other panel speakers to share their perspectives on this topic, as well as their views perhaps on your paper. We've got Mahan and Benedict. You up online?
Yeah.
Yes, me too.
Okay, wonderful. So, Mamahan, are you here? I think, Mamahan, you're due to facilitate this discussion. So why don't I pass it over to you, and I'll let you manage the rest of the conversation.
Okay. Thank you, Benjamin. When we first saw this paper, I mean, Dennis has submitted it to a journal. We really saw something very unique out here. And the practical side of it, because I believe for the Asian audience, the point I'd like to make is, as we go forward and as the larger banks move from T2 or T1 towards T0, most of them have to compete in this new space at T0. They will lose float. Whether Dennis calculates 10 minutes or an hour, he does mention some of the other markets may be slower. If you lose an hour, or if you need an hour, that means you're looking for some window of time from the regulatory side. On the other hand, the fintechs and PSPs, the business model is not about netting and float. They don't get any float. So they do want to do atomic settlement. So the challenge remains is, going forward, as the larger banks with all the global hubs, will they be able to carve out a regulation as per Dennis's model, a hybrid solution where they get an hour for the netting? Because if they don't get that hour for a netting, then PSPs, the fintechs do have something which the larger banks would not have. And in that context, I'd like to just leave one more thought. Bank of England had a paper in December, a discussion paper on stable coins, which has the underpinnings of a few things, that even if you're a large bank, you may need to ring fence your T0 business. So if you put all that together, banks really need to think, could you compete with the PSPs if it's indeed ring fencing of business, because you lose the float? If the banks get away and get that hour of netting, then the PSPs and fintechs loot. So there is some asymmetry out there, and we remain to be seen how time will unfold that asymmetry. I leave it to the others because I do want to take one or two Q&A from the audience. Benedicte or George?
Yes, so I won't comment for very long, given that we're nearly out of time for this seminar, but maybe to just observe that this question on T+0, I heard recently an interesting perspective I found by the chairman of the SEBI, which you also had on your slide, Tennis India. And she gave the the viewpoint that India should move to T+0 in her view, because the new generation is going to get used to these tokenized assets, and currently these are crypto assets, which are all instantly settled. And she said that her perspective, her viewpoint was, or the risk that she perceives, is that there will be less liquidity in the stock markets in the future, if you fast forward 20 years, if this new generation is used to see instant settlement elsewhere. So that was a way of thinking, thought that actually hadn't occurred in my mind. I know there is the permanent quest to T+0, but what we have to realize is that T+0 is already here to a certain extent today in the form of these crypto assets and tokenized assets, which I think Georg can comment on. So the question of how the expectation of the markets will evolve towards T+0 is important. Now, from our perspective, we are primarily working on a payments infrastructure, which we call the mBridge, which George in the prior panel has also touched upon. And that is really PVP. In some, it is instant atomic cross-border payment. The current intention is that it is used for trade, so normal payments for trading activities between corporates. But of course, in an extension, that could be used for DVP as well. So if there are specific cross-border DVP use cases, they are not to be excluded from the mBridge scenario. And I'll leave it at that, given the short time we have.
Yeah, if I could just respond to that, I would draw a distinction between consumer, which I'm not talking about, and wholesale banking. So although the consumer transaction looks instantaneous, you can bet your life somewhere, someone is giving you a credit line. Some bank somewhere has given a credit line for that to happen. And so what we're really talking about here is the larger institutions trading, while they may have to adapt their business to facilitate the consumer demand for instant settlement, but there will still be these issues, I think, in the background where credit lines and liquidity lines have to be provided to make this all work.
Yeah, I can maybe add a bit of a sort of practical perspective from what we see with our customers. Certainly, trade settlement is a big topic, and the whole move to T+1. There was a recent article by Larry Tabb, Bloomberg Intelligence, that estimated that this would cost the industry like $31 billion a year. So the impact of that is quite large. But you also have to consider that there are related activities that also have to adopt to that. Things like margin collateral has to flow much quicker, and it can only do so if it can do so similarly seamlessly as you have with tokenized assets. And the other part is of course all the, let's say, more settlement orchestration activities like allocations, affirmations, confirmations. That's another topic that just needs to basically go in lockstep if we move to these new regimes. And to give you an example, we've worked with the Hong Kong Exchange on their project Synapse, which is exactly trying to address these problems in the other direction. So it's addressing the time zone challenges that foreign investors have in the local market. But there again, like bringing in a distributed ledger as a single source of truth and removing all those bilateral, multilateral, message-based synchronization mechanisms is really a prerequisite so that you can actually move to shorter settlement cycles. So I think that technology is there, but there's a lot of moving parts that need to be addressed in order to actually achieve that ultimately.
Do we have time for one or two questions, Benjamin? I know we are we are done with time, but we could take one or two from the Asian time zone.
Yeah, I think there's a question/comment that came in. So from Albasha, however, it could be the case that a wholesale settlement platform with tokenized financial assets, in brackets, securities, bonds, etc., will be, although interoperable with, an RGTS or CLS system. The other point is that a DLT network will most probably be a permission private network, hence expecting higher performance. A good example are BIS projects Helvetia 1 and 2. Any color you want to add on this for the speakers?
Well, I can certainly add a point on the aspect of DLTs being sort of private permission. I think we've been for too long kind of in this dichotomy of you're either public, you're either private. There is a space in between, which is where we are positioning ourselves, because there's fundamentally it comes down to two requirements, right? You want to have a certain amount of control, which is often given by the regulator, but also you want to have that connectivity, that seamless connectivity that you see from public chains. You want to bring that into traditional finance. So as long as you can have those two properties, I think the technology is ready to support these sort of new rails, essentially, for assets as well as cash.
Yeah, if I could just make a point on this question. I deliberately try to steer away from technology and just ask the question. I assume that the technology is there to do whatever we want to do. Ask the question, what happens to trade financing today versus tomorrow when we move to instant settlement? We can actually calculate the economics of it. And a lot of the, so you go from a situation where the funding is today is to a certain extent financed by the netting benefit that you have. We saw there was 98% netting benefit of the DTCC, to a situation where, in principle, if you move to atomic settlement, it's completely equity funded. That is an enormous shift for a business. So I'm actually just talking about the business model rather than the technology that we might have that do wonderful things. And the question was really, how do you maintain some of that economics, if you like, so that you don't completely destroy the trade financing that's set up around the equity market because we're able to do instant settlement with digitization. So it's a question of, obviously things will converge to some happy medium somewhere. We can't even get to T+1 right now, never mind T+5 seconds, but what does the future look like? And I think there has to be serious study done of what happens to the economics of transactions, individual transactions. That's still out of reach, although this kind of perspective allows you to estimate and trade off the deterioration or the less credit quality assets, the decrease in RWAs, for example, versus the increase in liquidity that would have to happen. You can see where the sweet spot is. So I think I don't know what the future is, but it's going to be some kind of meeting in the middle somewhere. And what I'm saying is the middle actually is not quite the middle. It's like 10 minutes or something. It's not T+0, end of T+0. It comes very down to very, very small settlement windows.
I don't know if you have any more questions. I think
So I
most
have
of
a
them will
question
argue
for.
that.
Yeah, I have a quick question for Dennis. Dennis, on one of your slides on the bottom, it says 98% benefit from multilateral netting in US equities. You mean is in US equities?
Yes.
Okay.
Sorry, in the NSCC equity markets, yeah.
Okay.
Which is enormous. So the question is, where's that going to go? What's going to replace the financing that's implicit in that tomorrow when you move to shorter settlement windows?
Yeah, got it.
And I think that is to your earlier point. You're right that markets will not just change overnight. I think the change will come not as a revolution but more as an evolution. So as we're moving from T+2 to T+1, certain things will come out which will need to get fixed, and certain business models will maybe not work as well anymore. The costs will arise at different places. So I think it's going to be an evolution towards a new operating model that will then allow participants to also adapt over time. So I think I'm not a believer in the sort of the revolution theory that things can change overnight and people will adopt it.
There's one final question that came in from Tirupam. So very interesting presentation. Just one observation, whether a 10 or so minute window can achieve 90% of the netting benefit depends on trading intensity and market depth. As such, should faster settlement could be available as an option to traders. So as such, should faster settlement be available as an option to traders?
I don't think the answer is a one-size-fits-all answer, as he's pointed out. It depends which product segment you're talking about and which customer segment you're talking about. Some, like hedge funds, are very price sensitive, but also don't like to have their assets tied up for quite a long time. So you can see a set of different models arising which charge different prices depending on the length of the settlement window given. So for hubs, banks like a JP Morgan or somebody, it's a big deal to get those extra few minutes for the settlement window. Not so much for a hedge fund because it's not doing that many trades in the scheme of things. Maybe trades with, in relative terms, the number of trades are going to be smaller. So they might pay more for faster settlement, but JP Morgan would have to look across the entire business and say, how much is this going to cost us, and work it out from first principles. And it's a big deal for them. Yeah. So the hubs, you can see the hubs being charged differently and have different settlement times to, very agile trading funds, for example.
Wonderful.
That's a good point.
I think that's all the questions, and I am mindful of time. Hang on, there's one new message that came through. Oh, thanks. Okay. Well, I think that is all the questions, and that does bring us to the end of time. Unless there are final comments from the panelists to wrap things up on the topic of atomic settlements.
All I want to say is this is something genuinely new. A lot of folks have not realized that this new world of fintech PSPs is here. There will be clients, as I think Benedict mentioned, the speaker, that the younger generation wants everything right now. So T0 is here. Whether we give them that option, and if we don't, they will carve out a market. We have already seen this in the market for stablecoin. It remains robust around 120 to 150 billion. And if this is not addressed, I have seen the reminiscence of the euro dollar market. Some things will survive. So I think it's very intriguing. And will the banks be able to must be seen? Otherwise, right now there is an asymmetry. The banks are moving from T1 to T0, and they're not ring fencing it, and that's a real issue. You have the PSP fintechs who have to ring fence by definition. They don't believe their model doesn't have netting. On the other hand, the banks are moving, but they're not asked to ring fence. So they have a lot of latitude. They are subsidized by the float. This is the issue. How does the future unfold these issues? Anyway, I'm done. Thank you very much, Dennis.
Thanks, Manmohan. And I think on that note, and Dennis, appreciate your opening comments, and Georg, again, your additional color. Benedict, let me pass it to you because we did organize this in conjunction with BISIH for perhaps some closing remarks. Thank you so much.
Thank you. I'll keep it short again. I think the closing remark on the first panel was coexistence, and I think on this one as well. So in sum, what we are witnessing is very significant changes that have come from left center and continue coming from left center. And while I think it's very difficult to replumb the existent TradFi markets, and while that will take a long time, as Mahanman just said, this other activity will just continue going on and will carve out a bigger space if the TradFi space is unable to adapt. So the question is, how long will that evolution take? Is that 5, 10 year, 20, 30, 40 year evolution? I don't want to make a guess right now when they will break even, right? It could take a long time, but certainly if one cannot adapt, even if it is for commercial reasons, for good commercial reasons, then that doesn't prevent the other one from nevertheless being nascent. And I would refer in that regard to anything we've seen with the platform economy. My last 25 years have been transformed primarily by the platform economy and by the big techs. And I think we will continue to see that evolution. And this, as said, is just big tech and platform economies that eventually will impact the closed gardens of TradFi. Maybe that's what I'll leave it at.
Beautifully said. Thank you so much, Benedict. Well, look, appreciate all the speakers in session 2 as well as those on session 1 for what was a really enriching and fruitful hour and 43 minutes of discussion. Apologies to everyone that this did go over time, but hopefully you took something very useful out of it and managed to hear a lot of different perspectives that added to your knowledge base in this particular domain. We appreciate your patience. We appreciate your engagement. Stay tuned. This is not the last of the things that we'll be doing in this space. So, you know, make sure you follow what we're doing at BISIH, Journal for Financial Market Infrastructure, as well as Quinlan Associates. And we'll definitely keep you updated as things go on with new and exciting updates and hopefully some great events in the pipeline. Thank you so much. Enjoy the rest of your evening or day, wherever you are in the world, and look forward to connecting soon.
Thank you.
Thank you. Thank you.
Thank you.
Bye.
Thank you.